Ladies and gentlemen, welcome back to the channel. Tesla stock had what I would call an okay day today. Considering all of what we got, I wouldn't say it was a great day. I wouldn't say it was a bad day. Now, here in today's episode, we're going to be going over the latest in regards to Tesla, the broader markets, China, US trade, and what's coming next, where we are, okay? Do I still think a rally into the end of the year is coming? We'll go over that. I do have one clip from CNBC I want to share with you from Carson Research. He says some October volatility is perfectly normal. And he's like top 5 fund managers that I highly respect, alongside, Warren Pies and Tom Lee. Carson Research, add him to that group as well. Probably another one or two that I think highly of. These guys have been spot on for years now that I've been following them. And Carson Research tends to have some really good historical facts that pertain to the market. So I think you guys will get a lot of value out of that as well. We will take a look at tomorrow and any economic data that could be coming out or events. Now, we don't have any economic data tomorrow, spoiler alert, but we do have Fed speakers. And we do have a report from the Fed coming out, which could be important at 2 p.m. Eastern Standard Time tomorrow. So hit the like button as well as subscribe to the channel if you have not done so already. Check that link out down below in the description of this video if you want to come trade with us. Come invest in AI, software, gene editing, biopharma, quantum robotics. That is the place to be. We are outperforming all hedge funds and institutions this year by a mile. By a couple miles, and I think it's the greatest trading and investment community in the entire world. So check it out, link down below. You can also come talk to myself and the other members over there, so that's pretty awesome too. But nonetheless, let's go ahead and get started with today's episode and Tesla stock. So brief recap, what happened today? Okay, 2 parts. Jerome Powell gave a speech today. The biggest thing we got out of that is Powell said, look, the government is shut down. We're not getting some data, but the Fed still has a lot of data to go off of that isn't necessarily public information. Okay, so the Fed is still getting quite a bit of data. Jerome Powell says not a lot has actually changed from September. Like, he basically said if we had a Fed meeting again, like right now, it would sound the same as September. Things have not gotten dramatically weaker in the labor market. Inflation has not dramatically spiked. The economy is not dramatically strengthening. It's kind of the same old, same old. That relieved a lot of pressure that Wall Street had, because the risk was, if the government shut down, if the Fed is in the dark, if investors are in the dark, 3 months later, let's say, you could have a situation where, oh crap, come to find out, the economy is in the shitter, and the Fed didn't even know about it. Now the Fed's behind the curve. Now we're in a bad situation. Now we're close to recession, and yeah, that wouldn't be a good outcome. The Fed basically said they have an understanding of where the economy is. So that sounded good. The other big thing that caught my attention in the headlines was Powell said that the Fed's pretty close to ending balance sheet runoff. Now that provides a lot of upwards pressure on interest rates. The Fed running off its balance sheet is partially the reason why let's say the 10-year treasury yield, for an example, has been above 4% for so long. As the Fed stops running off their balance sheet and stops selling so much into the marketplace every month, that will allow 10-year treasury yields to actually come down. Okay? Bond yields work like a dividend stock. So imagine a dividend stock at $100 paying you 5%. That's a 5% yielding dividend stock. Well, imagine the Fed is coming out and they're selling that dividend stock. They're pushing it down to, let's say, $50. Well, now that pays you, what, 7.5%? Or no, 10%? 10%? Because the Fed's selling. They're selling like crazy. There's the normal market buyers of that stock, but the Fed is adding this selling pressure. Well, selling pressure goes away, buying pressure remains fixed. That leads to the price to go up. Now imagine that dividend stock paying you, $5 a year. It's $100 stock. It's a 5% yielding dividend stock. Great. Imagine that buying pressure pushes that stock to $200. Well, now it's only paying 2.5%. You get it? So bond yields are correlated just like a dividend stock. Stock price goes up or bond price goes up, yield comes down. Okay? Selling pressure is in the bond market, just selling. Well, price falls, yield goes up. Okay? Well, it stays the same at $5 a year, let's say, but the price falls. So now the yield you're getting as the price falls is higher, okay? Hopefully most of you guys understand that. So those were the two big developments we got from the Fed. The third one I would add is Powell did not push back on what the markets are expecting. The markets are expecting solidly or firmly a cut in October and a cut in December. Powell did not push back on that. Powell did not try to change market expectations. Powell could have easily said this one quote that would have really hurt markets today, really hurt the odds of a rate cut. It could have read something like this. Breaking news, Jerome Powell says because of recent uncertainty in trade, maybe it's appropriate to pause the rate cutting cycle. That's all it would have taken or took, and we could have a much different reaction in the markets today. Markets probably wouldn't have liked that all too much. Okay, so those are the three big things that, changed today via Powell's speech, okay, or confirmed for markets. Now, we still have the big problem on our hands. What is the big problem on our hands? Trade with China, okay? So trade representatives today, Besson, Greer, came out and basically said the ball is in China's court. That if China wants to de-escalate the situation, they can. If they don't want to de-escalate the situation, they won't. And tariffs could even go into effect sooner than November 1st. It depends what China wants to do next. Scott Besson said that China is failing and China wants to take everyone down with them. Okay? Greer said that he believes China acknowledges that they, did something they shouldn't have done. Okay? With the export controls. Greer also confirmed that there was state-level talks between China and the U.S. on trade today. That sounds good. It sounds like generally we are heading in the right direction on getting this resolved without a trade embargo on China. China and Trump both know if you cut off trade with each other, that means China goes into a recession. That means the U.S. goes into a recession. That means a global recession. Trump doesn't want that. China doesn't want that. Nobody wants that. Okay? Just who's going to make the first concession, the schematics of it, right? The I don't know. You guys get what I'm trying to say. Who's going to be the first one to say, okay, I messed up, shouldn't have done that, let's talk, right? That's what it sounds like we are waiting for right now. But it is a very uncertain situation. We weren't expecting the export controls that China was going to put on. We were not expecting Trump to fire back with a 100% tariff threat. Okay? We were not expecting that. So I'm not going to be the guy to say, the all clear is here. The odds do favor this gets resolved and stocks move higher based on this. It's not a guarantee. You need to be prepared for anything to happen in this environment. There is zero certainty about anything. But the highest likelihood favors this situation getting resolved, getting 2 rate cuts this year and probably another one in January. Jerome Powell is leaving, in April? A new bullish Fed chair. Likely more room to cut next year than what the markets are expecting. I believe inflation is going to continue to come down. I believe AI is alive and well, and it's going to be alive and well for at least 2026. I don't think we're in a bubble. Okay? I think we could get into a bubble at some point, but I don't think we're there, right? Because why? China. It's an AI Cold War. You have no choice but to compete and to spend. Okay? If you're Google, you have literally zero choice but to compete and spend. Just that's the facts. So there's like an internal Cold War in this country between companies, and then the broader force, which is America needs to beat China with AI. And China's ahead in some areas, they're behind in other areas. It's very much still a neck and neck competition. Okay? But that's going to help fuel equities to do very well over the next 12, 24, 36 months. And you need to be invested in this market. You know, a great saying, bulls make money, bears sound smart. Bears make good arguments, okay? They really do. But they don't make money. I would rather make money than make a good argument. Now, furthermore to that point, for 2026, big beautiful bill. No tax on tips, no tax on overtime, tax changes. A lot of things start to really benefit the consumer starting next year, about mid-year on taxes. Okay? Awesome. Tesla specifically is going to have massive growth in AI from an FSD perspective, probably getting to the unsupervised FSD at some point in 2026. Even more so than that, the robotaxi network is going to be massively expanding next year. Okay? Furthermore, on top of that, Optimus. Okay? The things that really move Tesla is robotaxi and Optimus. Even by year end, I don't know about you guys, but robotaxi has been really quiet. We haven't heard anything new in a while. I think we're going to get a new city being launched. It looks like at this point it could be Dallas. Okay? As long as shit doesn't go really bad with China between now and then, Tesla stock has considerable upside from here. I think you could be a $600+ stock if trade with China calms down. Shareholder meeting goes well. Elon's compensation package gets approved. Tesla takes an investment in XAI. We get another city with robotaxi. You know, that's it. Donald Trump today actually says, this headline, pretty interesting. Trump says that he thinks the relationship with China will be fine. He says that we have a great relationship with President Xi. Sometimes it gets testy. I think that is telling you we don't have that much to worry about. I think markets are still nervous, but this is probably going to blow over, okay? Probably. I give it like a 20% chance that things get worse from here. The tariff goes into effect. We have a trade embargo with China for a certain degree of time. It's probably a less than 5% chance it lasts more than 3 months. Okay? That's where things really start to get critical. Is like 3 months of no trade with China. Shelves start to run dry at that point. Okay? So I think there's less than a 5% chance of that. Probably an 80% chance that things get solved before November 1st and there's no tariff in general. Maybe a 20% chance a tariff goes into effect, but it gets solved in a month. Okay? There's probably a 10% chance that the tariff goes into effect and it does not get solved in a month. Okay? So that 5% chance, that 10% chance, even that 20% chance could constitute large downside in markets. But it's just not very likely. So if we do get any more fear, if we do get any more downside in stocks, that, in my view, is a buying opportunity, especially for your higher quality names like Tesla that have massive runways of growth. Okay? People care about AI with Tesla now. That is what is going to move the stock the most. And Tesla's just getting started there. We're going to have some incredible growth with Tesla's AI projects over the next 12 months or so. Now, tomorrow, we are going to get a speech from Fed Bostic, Fed Moran, and Fed Waller between 12:10 p.m., so around noon, and 1 p.m. You get Fed Schmidt that gives a speech at 2:30. You get the Fed Beige Book at 2 p.m. Okay. Fed Beige Book is basically a rundown of San Francisco Fed, Kansas Fed, Dallas Fed, New York Fed, Chicago Fed, Philly Fed, I think there's a New Jersey Fed. There's a bunch of them, right? They all give their own readout of what's happening, Atlanta Fed, in their own districts, okay? So it's a pretty comprehensive understanding of the economy. Wall Street may pay more attention to that versus normally it's not something that moves the markets all too much. But since we're not getting much economic data, and based on what Powell said today, it might actually move the markets quite a bit tomorrow. Now, you also get the New York Empire State Manufacturing Index for October, expecting negative 1.8. Last month was negative 8.7. So you're expecting an improvement in that data set coming tomorrow. Now, I want to make sure we cover this as well again, what Ryan Dietrich said about this market in today's episode. So we're going to go ahead and share this and then talk a little bit more about Tesla, my thoughts specifically for Tesla stock into year end. So take a listen to what Ryan Dietrich said about markets.
Let's get your diagnosis of what we've seen. Thursday, Friday, S&P goes down 200 points. We're up about 105 today. So what do we make of this seasonal pullback?
Yeah, first off, thanks for being back, and happy Monday, everybody. You think about it, Mike, we went 33 trading days in a row without a 1% move, either up or down. That was the longest streak since before COVID. So to say we were due is probably an understatement. You look just at the last 2 days, yes, probably 2 days now, 1% moves. Just October 13th, little history for everybody. At 89, the S&P dropped like 6% on the UAL LBO deal that fell apart. And then in 2008, this day, October 13th, gained 11%. Mike, I'm not sure why, but there are more 1% moves in October than any other month. After I guess I'll say we've been spoiled with this rally. Maybe some October spookiness and volatility is perfectly normal.
Certainly normal. I guess the question is, did it kind of break the market stride in any notable way? I mean, it's essentially, once you've got the people who are in it because you can't get the market down, and this is a low volatility grind higher, and there's no real use in waiting for a dip to say, okay, maybe we're going to get a deeper pullback.
You're right. I love the discussion with Paul a little before I came on. He talked about some of the internals that are weakening. I look at things like regional banks. Those are lagging big time. Housing's lagging big time. Look at high yield credit, right? That's starting to crack. So by no means are we saying there's this big monster under the bed. But, Mike, there are some little things that have me concerned. And the last one, put to call ratios, they're quite optimistic. And from that contrarian point of view, I just think it makes sense after a 36% rally in 6 weeks. Maybe we're due for just some, I guess, a Charlie Brown shirt type of volatility.
You mentioned 35% up in 6 months,
yep.
Right? So I wondered if we were also suffering from a little bit of anniversary-itis in the sense of, wow, look at this massive 6-month move. Obviously also just hit the 3-year mark of the current bull market with some great gains, although maybe not, kind of middle of the pack on the 3-year anniversary. Mm-hmm. But what can we expect from here as the bull market matures?
Yeah, we're still pretty optimistic, have been for a while. You look at, there's been 5 other times we've gained more than 35% on the S&P in 6 months. 1 year later, higher every single time, up like 13% average. I know some other guests have pointed this out. I'll just mention it. Once you get a bull market that gets to this point on its 3rd birthday, there's been 5 other ones back to 1950, all right? The shortest any of those other bull markets went was 5 years. The average, Mike, was 8 years. So listen, the reality is this is a strong bull market still, and to think it's just going to be over because we're here and it's 1929 or stocks are overvalued, we're not minimizing that, right? Earnings are still strong, profit margin strong, a dovish Fed. There are still reasons to think that this bull market's alive and well, and it might last longer than a lot of investors expect.
Yeah, I mean, now granted, that's what the math says, although it owes a lot to two very, very long bull markets, right? I mean, one that began in 87, the other one in 09. Fair enough. I guess the question is, where within the market, I mean, are you looking for some leadership transitions, large to small, away from growth to value, or stick with the winners?
We're sticking with who brought us to the dance, I guess we'd say. We still like industrial, still like cyclicals, financials. And we do like large over small. No small's coming back today. We just think the Fed's probably not going to cut quite as much as what the market's expecting the next 15 months or so. I mean, there's still a lot of opportunity, right? When in doubt, diversify it out. There's been a great year to have a diversified portfolio. We're not changing that at all. We'd still just be overweight equities with a little bit specifically of developed international. We've liked that group for a while. Still don't think that one's over as well.
Yeah, that's right. So it has obviously been a global move as well. Quickly, Ryan, earnings growth for this quarter, probably not as underestimated as prior quarters.
It sure isn't. You know, you look at the pre-estimates, right? Actually, a positive pre-estimate on average. You haven't seen that since, I think, late 2021. So a lot of good news is out there. So that's something. Maybe the bar is a little bit higher. But once again, I think earnings will probably come in better than expected. It's just how much better, because there is a little more optimism this earnings season than really the last several years.
So I think those were obviously very fair arguments from Ryan Dietrich. Now, again, for Tesla, it really comes down to what happens with China trade. Do things get better? Do they get worse? That's really just the easiest thing to say. If they get worse, stocks are going to fall. If it gets better, stocks are most likely going to rise. I think earnings are going to come in good. Again, inflation's going to fall. Consumers going to get a little bit better, especially in 2026. Okay, AI is alive and well. We're like second inning with AI. We haven't even gotten to robotics or anything like that. Like, AI has a long way of growth to go. Now, I think Tesla is going to become one of the hottest AI stocks on the marketplace. I think it's really just a matter of time. And I think as long as China tensions do not get worse, Tesla is going to see a very large rally into the end of the year, right? If things go back to kind of where they were, Tesla was just setting up a couple days ago for a move into the 500s. That is still alive and well, okay? So all it's really going to take is one piece of really good news to get Tesla into the 500s. And then you're going to be scorching to the 600s. Again, that's just my view. That's just my opinion. Let me know your thoughts down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. Have a great rest of your day, and I will see you in the next one.